Can you truly hit that perfect credit score without shelling out a dime? In this video, we're diving into how you can nail this, especially if you're just starting out on your credit adventure. Hello everyone, this is Foxfire Finance, and we are committed to spreading the great news and concepts of the FIRE movement to anyone dreaming of a better life. We aim to help you achieve your goals by providing meaningful tips and strategies that will bring you closer to your dreams of financial independence and retiring early. But first, don't forget to subscribe, burn that like button, and ring the notification bell to be updated on our latest releases to guide you on your way to FIRE. A credit score might appear intimidating at first glance, yet reaching that flawless score isn't about the cash in your pocket, but rather how smartly you handle it. So let's dive in and break down the process on how you can do this. Number 1. Understand what makes a credit score. A credit score is a numeric reflection of a person's ability to manage debt based on their credit history. Grasping its makeup is crucial for adeptly handling one's credit, and this is the first thing that you should aim to understand. Your payment history makes up 35% of your credit score. The main thing that affects your credit score is whether you paid bills on time. Think of it as a report card for your finances. If you regularly pay on time, you get good marks. But if you're late or miss payments, your score drops. So timely payments are key to a high score. The amount you owe, or rather how much of your credit limit you utilize, makes up 30% of your credit score. Imagine your credit as a bucket of water. The fuller the bucket, the closer you are to using all your credit. If your bucket is only a little full, it means you're just using a small part of that credit. It's better to keep your bucket less full. Lenders like it when you use only a bit of the credit they give you, rather than all of it. It shows you're managing your finances well. Now, length of credit history accounts for 15% of your credit score. It's a way of seeing how long you've been in the financial game. It looks at your oldest financial account, your newest one, and the average age of all your accounts. Essentially, it's like checking the start date, recent activity, and overall duration of your financial actions. Lenders value this because a longer history often indicates more experience with handling money and debts. The number of accounts you've opened lately makes up 10% of your credit score. It counts how many new accounts you've opened lately and how many times lenders have checked your credit. Opening lots of new accounts quickly can look risky, like you might be borrowing too much too fast. It's a way for lenders to see if you're taking on more than you can handle. And finally, the types of credit you use makes up 10% of your credit score. It's like a financial pie with slices of different credits: credit cards, store accounts, regular loans, and home loans. Having a variety of these slices is good because it shows that you can manage different types of debts responsibly. Now, how's that for step 1? Understanding the composition of your credit score is critical before you can truly strategize on how to make your credit line work to your advantage. Now, let's move on to number 2. Start with what you have. Monthly bills and subscriptions like your phone or favorite streaming service might seem like routine payments, but they can play a role in your financial narrative. Every time you pay these bills punctually, you're demonstrating financial reliability. Think of these payments as mini tests. Pass them by paying on time and you're proving your dependability. In recent years, there's been a shift in how creditworthiness is perceived. Traditional markers like credit card payments are no longer sole indicators. Many services are now recognizing the importance of diverse payment histories, including those monthly bills you never thought twice about. Companies like Experian Boost allow you to add these regular payments to your credit history, giving you an opportunity to enhance your credit profile. This evolution is especially beneficial for those who might be new to credit or those looking to rebuild their credit score. In essence, it's adding more ways through which you can showcase your financial responsibility and eventually help you in building your perfect credit score. Now here goes number 3. Secure credit cards. Starting your credit journey with an empty wallet might sound like a challenge, but there's a solution many overlook, and by solution, I mean secured credit cards. Unlike regular credit cards, secure cards work as a pay-first method. You provide a deposit up front, and that deposit typically acts as your credit limit. Imagine it as a safety net for the bank. If you ever fail to pay, they've got that deposit as a backup. But why is this great for you? It offers a chance to show banks you're trustworthy, even if your credit history is sparse or non-existent. If you got some savings or perhaps can borrow a bit from someone close to you, this can be your entry point. The key is to be disciplined. Use the card for minor expenses and clear the balance every month. Over time, this consistent behavior not only boosts your credit score, but also graduates you to traditional credit cards. Secured cards, in essence, are like training wheels for credit management. Now let's go to number 4. Become an authorized user. Knowing someone with an impressive credit score can be more advantageous than you might initially think. Being added as an authorized user on their credit card is like getting a VIP pass to the world of good credit. Now here's how it works. It basically means that the primary cardholder, the one with the solid credit, allows you to piggyback on their account. Even if you don't swipe the card or make a single purchase, their responsible behavior benefits you too. This method is similar to being under the wing of a financial mentor. Their timely payments and wise credit decisions reflect positively on you, giving your credit score a potential uplift. It's a testament to trust, as they're essentially vouching for you in the financial realm. Now there's a catch though. It's crucial to ensure that the primary cardholder maintains their good habits. If they waver, it could affect your score negatively. So choose someone reliable and enjoy the shared benefits of responsible credit management. Now let's move on to number 5. Build a mix of credit. Think of your credit like a well-balanced meal. Just as variety in diet is healthy, a mix of credit types, credit cards, retail accounts, and installment loans enriches your credit profile. But you don't need to dive in deep immediately. A good starting point is a credit builder loan. It's like a financial stepping stone. With these loans, banks secure the borrowed amount. As you repay, the bank reports your timely payments, building your credit reputation, and once you're fully repaid, the money's returned to you. Over time, you should gradually introduce different credit types, showcasing your adeptness at managing diverse financial responsibilities. Don't forget tip number 6. Monitor and dispute any errors. Errors in credit reports might surprise you with their frequency, much like finding unexpected items on a shopping receipt. Just as you double-check a bill, it's vital to review your credit reports regularly. With free monitoring services available, it's become even easier to keep an eye on your financial scorecard. These services act as watchful guardians, alerting you to any unusual activity or discrepancies. If you stumble upon inaccuracies or outright mistakes, don't hesitate to raise a dispute. Addressing and correcting these errors can be similar to cleaning up clutter. Once cleared, your credit score might experience an uplift, reflecting a more accurate representation of your financial behavior. By being proactive and vigilant, you ensure your credit report remains a true reflection of your financial history. And finally, always remember tip number 7. Patience is key. Your credit score, much like a well-aged wine or a tree's growth rings, gains depth and richness with time. It's not merely a snapshot of your current financial moves, but a cumulative record of your monetary journey. The longer your credit history, peppered with responsible decisions, the more it showcases your consistent financial behavior. Every timely payment, every practical decision is like a brushstroke in a broader picture of reliability. Remember, in the world of credit, patience is vital. It's like running a marathon where endurance, persistence, and a steady pace matter more than short bursts of speed. In this long race, it's the years of positive actions that truly push your score upwards. So, play the long game and let time work its magic on your credit score. Remember, it's not about how much money you start with, but your financial habits and decisions. And while a perfect credit score is a great goal, what's more important is the journey and habits you develop along the way. Did you find this video helpful? If this guide lit the spark for your wealth journey, then burn that like button and don't forget to subscribe to our channel for more tips on how you can reach your financial goals. Until next time, we are Foxfire Finance and keep that fire burning.